All right, welcome everyone, and good morning, good afternoon, or good evening, depending on your perspective on this world. Welcome to Trading Coaches Playbook. Brandon Wendell with you. Whoops, I just hit the wrong button there. Hang on. Trying to find something else. There we go. Okay. And whoops. All right, there we go. Low volume, there's not much I can do about it. Maybe on your end, you can turn it up, but that's all I can do. I got my mic set. Let me make sure it's the right mic, though. I could check. Yep, it is. So as far as I can tell, that's all I can do. Yeah. Sorry. My mic is the normal mic that I use, and it's in the normal position with the normal volume. So I'm not sure what happened there. Um, anyway, we'll go ahead and kick this off. Before we get started, I just need to remind everybody that we are not broker dealers or investment advisors. We're going to be looking at the markets from an educational standpoint, which means I'm not telling you to buy, sell, or hold anything in particular, or giving any personalized recommendations about the markets. All markets do involve the risk of loss. That's always the situation. No matter what we do, we can never eliminate the risk. We just try to minimize and manage it. And we're not subject to trading restrictions, so we can have positions in a security or initiate them at any time. And let's see, I'm going to check something here if I can. See, audio settings, mic. Yeah, I can't really do much more with the mic. It's showing it's good. I don't know. Yeah, input. But anyway, okay. So welcome. Like I said, this is one of our free online workshops. We do one every Friday as a Trading Coaches Playbook. Rob also hosts Power Hour every Monday. You might want to catch that and see what kind of info you can glean from him. A lot of good education, a lot of good information from my fellow instructors and traders as well. I'm pretty busy during the week in the E-mini Think Tank, Monday, Wednesdays, and Thursdays from 9 to 11 a.m. We do live analysis of the futures markets. I also do an options program called the SPX Cash Flow Secrets, which is kind of a self-paced learning, education, and trade ideas using options. And that's kind of what I want to focus on today. I was going to talk about some options trading. Even though I do focus primarily on futures, I do trade options as well. And I even have taught in the E-mini Think Tank about options on futures as well, kind of combining leverage on leverage, which is pretty cool. And a lot of people, I don't know, they get confused or they're not sure exactly how to effect a proper options trade. And I try to keep it as relatively simple as I can. So let me go ahead and there we go. Just maximize a chart. And that way I can draw on it as well. Let me see. First of all, now I may be oversimplifying just a little bit for explanation purposes, but bear with me a moment. Okay. Basically, when I'm trading options, I do three main steps. And of course, there's a lot of kind of sub steps, if you will, or things that I do in more detail. But for the most part, number one, I start off and I analyze the underlying, whether it be a future, a stock, whatever it may be. And basically, what I'm trying to do is figure out, are you bullish, bearish, or neutral on that security? And for the most part, we should have some sort of a bias just looking at a particular security of whether or not it's an uptrend, downtrend, or if we're in a bit of a sideways trend and how we want to play that. Now, do we expect that bullish trend to continue? Do we expect it to die off? Are we looking for a reversal of the trend? What is it that we're trying to accomplish here based on that underlying security? Which way is it likely to head? Once I figure that out, and I'm going to turn to my options to be able to play that, there's so many different option strategies that you can use. And I obviously want to choose the right one. But really what it comes down to is, for the most part, in options trading, you have debit strategies and credit strategies. Are you willing to buy or are you willing to sell? And what I'm looking for in order to decide whether I should be doing debit or credit strategies, part of it is risk analysis and figuring out how much risk I'm going to be willing to take. Some of the credit strategies may have higher risk than debits, but there may be higher probability for success because typically when you sell options, you can profit if prices go in your favor of the underlying, if they go slightly against you, or if they go nowhere. When you do debit strategies, you typically need a significant price move in the underlying security. So that way you can cover not just your premium, but also make a profit. And you need to do it in a certain amount of time. So that way the strategy is profitable before the time decay, eats up all the potential profits. So what I need to know for debit or credit is, are options cheap or expensive? And there's actually quite a few different ways of looking at that and trying to analyze whether they're expensive or cheap. And then last but not least, choose and manage the right option strategy, right? 3 steps. And it seems relatively simple, but obviously there's a lot of pieces in all that. We're taking a look at, uh, just even analyzing. I analyze on multiple time frames. I want to make sure that I'm getting in where prices are likely to give me the best opportunity. Typically, I buy at demand zones and sell at supply zones on my what I call zone time frame. But I'm looking at that trend in a different time frame, a little bit bigger time frame called my trend time frame. And I make sure those two are related to each other because I don't want to trade trends that are not going to be impacting what I'm trading. For instance, I'm looking at heating oil, and we can always look at heating oil futures as well, or options as well. But if I'm taking a look here, we're on a 1 hour chart. I happen to have a potential demand zone here where there's an imbalance of buying pressure and a lack of selling pressure. Well, that could give me two potential uh, actions at that area. One, I could be looking to be bullish and go long when prices are likely to bounce from that area. Or two, I could be looking simply to exit bearish strategies or book some profits there. The trend kind of tells me what I'm supposed to be doing, which direction I'm going to be looking for trading. And same thing up here, I have an area of supply where I have an imbalance, lots of selling pressure, very limited buying pressure, pushing prices down. And I could either enter into a bearish strategy when we hit that area, or I could be looking to lock in profits on a bullish strategy. Again, the trend is going to be telling me which direction I should be trading, if any direction at all, because again, we could be neutral and we can even eliminate the directional risk when it comes to our option strategies. So let's see, I go from a 1 hour perhaps to a 4 hour time frame. And right now we are in a bullish trend. Prices are making higher lows, higher highs. There's a lot of green candles dominating, but there's definite weakness in that trend. As prices are making these new highs, there and there, you can see that we're doing it with a lot less momentum. And that's called a negative divergence, which is a warning signal that the trend is getting weak. Now, trends get weak before they pause, and they also get weak before they reverse. So we need some confirmation to see if this is actually reversing or not. If we're in a bullish trend, I would be playing bullish strategies, obviously. If we're in a bearish trend, I'd be looking at bearish strategies. Well, I'm going to go a little bit bigger here to a daily chart. And I'm going to have to go to continuous because I'm not seeing anything on this particular security going back far enough. There we go. And make sure, let's see. On futures, there we go, adjust for contract changes. And now we can see on a daily chart as I go back a little bit in December of last year, the reason why we're stalling out where we are, this is an origin of some selling pressure on that daily time frame. So we may actually be getting a trend reversal here rather than just a pause in the trend. We have weakness being shown on the trend time frame, the 4 hour, and we're basically coming up to a big wall on the higher time frame. Again, one of the things I teach, let's see, do I have, oh, I don't have it open right now. I was working on a bunch of different things, so open up Wealth Builders here for a moment, close something else. There we go. Oops, sorry, I should have logged in earlier. There we are. Doesn't take long. It shouldn't. There we go. Pretty fast. So if I go into E-mini Think Tank or with options, I mentioned I had the SPX Cash Flow Secrets program. And in that program, I have lots of educational videos. And one of those is trading routine and finding zones. And that teaches you step by step kind of what I do when I'm trying to find where to trade and which direction to trade in. Obviously, trying to find the trends and the trend reversals. So again, it's a lot of self-paced education in the SPX Cash Flow Secrets. And you can even learn the option strategies that I employ right here in the SPX Cash Flow Secrets, as well as some additional trades in there. But basically, this is looking like we may be changing to a bearish strategy. That means going all the way back down to that 4-hour time frame. And it was HOQ25. That supply zone, I'm sorry, it wasn't 4 hour, that was a trend, it was 1 hour. That means that that supply zone may be an entry point for a bearish strategy, while the demand zones may be targets to book some profits along the way. And we're likely to be beginning a downward trend. We haven't confirmed yet, though, so I might need a little bit more confirmation before I would actually affect that trade. But that's kind of my thought process, step one, in a nutshell. Again, I'm going over it kind of high level and relatively quick. There are a few more steps to that as well. Now, how do we figure out if options are relatively cheap or relatively expensive? There's actually quite a few different tools you can use. One that I like to look at is implied volatility. And if you go into studies, there's probably quite a few of them you can add. As a matter of fact, right here, volatility studies, look at all those you can add. And you got implied volatility, which is the simple one, but there's plenty of others. And basically, it depends also on which options you're trading. I should mention that. When we go to, let's see, trade, and I'll bring up heating oil futures and those options, specifically the August. There we are. Oop, wrong one. Yep, there's option chain, and we have the August options. Let's go to a single here. And let's look at the Greeks. There we go. Actually, you know what? This isn't going to help too much yet because I want to show a comparison. So now I'll just bring in regular heating oil and it'll show me the different contracts that are out there. We have July, August, September, October, November. Okay. And the reason why I wanted to point this out is when we're trading, we want to try to manage our risk. You know, we can never eliminate risk 100%. It's impossible. As a matter of fact, if you want greater rewards, you actually must accept greater risk. They go hand in hand together. So one of the things I want to look at is are the Greeks. The Greeks are risk parameters for the options you trade. We have delta, which is direction, D for direction. That gives you an idea of how the option premium will change when the underlying price changes. Gamma is an acceleration factor of delta. T, theta, that is time decay. That is basically your option melting in value for every day that passes. Then you have V, volatility. And typically Vega, not sure if I'm not getting good data or what. But typically volatility or Vega is the biggest influence on option pricing compared to all the other Greeks combined. So that's something we typically want to pay quite a bit of attention to, especially the further out in time you go. So if I go out to HOV, let's see, we can look at the October options. You know what? Let's switch securities. I'll just go QQQ, keep it easy. And there we obviously have plenty of options to choose from. But once again, I'll look at roughly 30 days till expiration here. And I don't need to see as many strikes. There we go. So at the money calls right now, about 526, we see that the volatility is 0.65. Okay, so Basically, if the volatility rises by 1%, you're going to get a 65-cent change in the options premium, or $65 for one contract. If it drops by 1%, same thing. It would drop by 0.65 or 65 cents on one contract that is 100 shares. That would be $65. Notice if I go out to, let's say, 90 days, and the same area, 526, 525, now we're looking at 525, and the Vega has jumped to 1.03. So it jumped by what, about 80, 85%? It's a huge jump. Notice the delta didn't change, 0.57, 0.55, right in the same area. The gamma didn't change much. The time decay did, it dropped. So the further out in time you go to expiration, the less time value is a factor. Typically, time value it's not linear, it's curved, and it exponentially increases in the last 30 days expiration. That's why typically when I'm buying options, again, I want to buy cheap options, I will typically buy 60 to 90 days out minimum. That way I'm reducing the time factor, but at the same time, I'm increasing my risk according to volatility dramatically. Again, it goes up quite a bit, doesn't it? We go out further, say 6 months, 180 days, 525s. Now we're at 144. And so it goes up more and more and more. We didn't lose as much time value. It went from 15 cents down to 12 cents, but volatility effect or exposure increased. So we have to be aware that the further out in time you go, the more you are at risk from volatility changes. Okay. So if we're buying options, again, I want to buy time. I'm trying to remove time as a risk. So I buy more time, I have less theta, but I'm increasing my exposure to volatility. So I have to be aware of that. And I can do things to offset that. One of the things we can do is what's called a spread. By buying and selling two securities at the same time, we can actually neutralize some of that volatility risk and take it away. So we offset it, but again, if you're reducing risk, we're also going to be reducing our potential reward. They go one and one, or not one and one. They're hand in hand. Let's put it that way. Okay. So again, looking at these options, I need to figure out if options are cheap or expensive, and what kind of exposure am I willing to take? Well, first, let's figure out if they're cheap or expensive. I mentioned implied volatility. Looking at the chart, we can actually chart implied volatility. Yeah, let me remove this for now. And I'm on a daily. Now I'm on 4 hour. Let's go to a daily chart. I typically look at daily, and I may be getting some bad data. I'm not sure. So again, I'll just use QQQ. All right, there we go. So what we're seeing is implied volatility is extremely low to where it's been. However, it's rising since early June. You can see right around June 9th, 10th. Is that what it was? Yeah, June 10th right here. Oops. Come on. June 10th, we started coming off the bottom, and implied volatility has risen. It actually rose from 20% up to about 23.5%. Now, technically, it was about 21. So it's only gone up 2.5%. But again, that can affect longer term options much more than it would short term options. So you just have to be aware. And I don't think this gives me an average. No, this one. I'm used to the TradeStation implied volatility. It shows you versus the average as well. I don't think I can apply an indicator to an indicator, can I? Whoops, that's not what I wanted. Maybe I can, but there are other tools, like I said, that I can use as well. So going back to volatility, let's see, what else do we have? I'm not sure what HL volatility is. Historic volatility is what they call statistical volatility, or basically the chart. It's the volatility in the past. The implied volatility is the expected volatility in the future. And we can see that we're relatively low and rising. Let's see, what is this HL volatility? You can tell I don't play with this as much. Values. I guess I have to look up to see what it is. I'm going to remove that anyway, because I have another indicator that I want to use in a moment. Because basically we need to know, is this relatively low or is it relatively high compared to the average and what's been going on for that security? We can also take a look, going back to our trade, see if I can change this one. I think that's right. Yeah, theoretical price. Taking a look again at roughly 30 days of expiration. Remember, I said that the implied volatility is relatively low, but it's rising. Well, if options are relatively low, then we should be trading below the theoretical value. And we're actually trading at theoretical value right now. So we're not really getting a discount by buying those options. See, theoretical price here, 1245, 1208. It's pretty much right in. So if you wish to buy or sell the options, you're pretty much trading them at their value right now. Now, implied volatility might be rising and continue to rise, which would lean me more towards wanting to buy options rather than sell options. Because if we see implied volatility is relatively low and expected to increase, then option value should also begin to increase. And I may have a better opportunity buying rather than selling options. That's part of my decision process. I also have an indicator that I share with my students, and it is, let's see, user defined. There it is. And you could probably recreate this. What that red line is on the bottom is the same thing as the green line. It's implied volatility. I'm going to remove the implied volatility now because I don't need to see it twice. But basically what this is doing, this bottom indicator is taking the implied volatility and plotting it. And it's comparing the 52-week historical volatility high and low. So I don't know, let's see. I don't think it shows it here for the IV. You used to be able to get it for free in the NASDAQ website. Let me see if I can still find it. They changed things around so much. Let's see, we'll do QQQ. And here we have the quote. And they used to have a section where you could find the implied volatility. There's a website called iVolatility, and there used to be a link, because if you just go to iVolatility, you have to pay. And I don't really want to pay for that if I don't have to. Let's see. Go to option chain, perhaps. They update the websites constantly, so stuff disappears. Nope, still not there. Interest, historical. No, that's about it. Unfortunately, I think they probably took it away, but they, like I said, they used to have a link where you could go to a security and then look at the historical volatility and implied volatility from that website. It was kind of neat because what you would do is take the 52-week high implied volatility, 52-week low implied volatility, and that's your range. Basically, that's what I'm seeing when I go to this chart. The 52-week high is currently, sit here. Yep, 0.503499. So basically 50% was the past year high implied volatility. The low is 10%. So what's happened is I've created a scale divided into 5 equal spots with the low of the range at 10% or 0.10, and the high at 50% or 0.5. Now, the scale will change depending on the security you're trading. For instance, if I go to a much more volatile security, maybe go to Tesla, that range right now is a low of 39% or 0.39 with a high of 111%, 1.11. And you can see where we're sitting right now is kind of in the middle. That means that options are about average price, They're not relatively low or cheap. They're not relatively high or expensive. We go, let's see, Apple. Again, they all have their own individual ranges based on how much volatility that security has. This is at 68% on the high side, 12% on the low side. And you'll notice we're in section 2. Well, anything low, but this is section 1, 2, 3, 4, 5. Actually, let me go back to Q's. Oop, wrong one. There we go. And section 1, 2, 3, 4, and 5. Clean those up. And again, it's just the implied volatility on top of the last 52 weeks historical volatility or statistical, whatever you want to call it. And we're just looking to see, are we relatively high or low? Now, this is just one way of looking at it. The other, like I said before, I can also look at the average implied volatility compared to current implied volatility. That'll give me an idea of where the implied volatility range has been. This is comparing the implied to historical. So the way I treat this is typically if we're in section 1, you see 6 lines. Well, there's 5 sections inside of those lines. Section 1, 2, 3, 4, and 5. It's wherever the red is sitting inside of. And you can see it actually can pop above section 5. But yeah, there's 6 lines. It's just inside. So this is the bottom of the range. And that's the first, what would it be, 20%, second 20%, third 20%, fourth 20%, and the 100% right there. So it's 20, 40, 60, 80, 100%. Yeah, that's how it's divided up. And basically in section 1, options should be cheap and undervalued. That typically means we want to buy, right? We want to buy cheap options. In section 2, oops, they're relatively cheap, but they could become cheaper. You could drop from section 2 down to section 1. In section 1, because things are really cheap altogether when it comes to the options, typically I do debit strategies when I'm going to be buying options. In section 2, I still can buy options, but I want to make sure I do spreads. So instead of just buying a call or buying a put, to protect myself against volatility going the wrong direction, I can put on a spread. As I mentioned before, when you do a spread, for example, if I did a bullish spread on these 30 days left till expiration, I could vertical. And where are we now? 527. I buy that 527 to maybe 530. Now I have to go to analyze, don't I? There we go. With the Q's. Those 35s, there we go. And again, we're doing the vertical. It's 527. And I was just randomly picking 530. The reason why we did that now is I can only see the delta and theta right here. Can I add in? Yes. Vega. There we go. So I can see my Vega. Basically, when I put on the spread, what I'm doing is I'm adding one and subtracting another for the volatility. What I mean by that is, again, if I go back to single, I bought the 527s There they are. Buying the 527 at a Vega of 0.66, but selling the 530s basically puts you on the opposite side. You are getting a negative 0.66. Not sure why it's showing 0.61. I was on think back, simulate trade. Because the Vega should be almost zero, going one positive, one negative, and they're about the same, unless I'm getting bad data again. Anyway, go back, delete that for now. Actually, come on. Open this up real quick. Help me out to show you some stuff. In the meantime, like I said, where's it here now? Update later, please. Yeah, there it goes. It'll take a moment to load. But like I was saying, is that basically when I'm looking at that indicator, back to my charts, if we're relatively cheap, I still want to be on the debit side and buy options. However, I want to protect myself by doing spreads because even though it's relatively cheap, it still could become cheaper. And by having a spread, I can neutralize some of that volatility risk that I have. In section 3, things are evenly priced. You can go long or short depending on the returns you might be getting when you plan out the trade. And of course, how much capital you want to put at risk. Section 4, now we're getting a little bit more expensive. And obviously, we're going to lean on selling options, but just because they're expensive doesn't mean they can't get more expensive. Once again, I can, in section 4, where we were back here in April, I could be putting on debit strategies where I'm selling options to try to collect higher premium. Okay. And then section 5, section 3, everything's relatively evenly priced. Yeah, so I go section 3, I'll put that in there. So things are at fair value, kind of evenly priced. You can either buy or sell. But typically, if we get into overpriced options, the more expensive something is, you can see here we were way above, and we actually got more above before we came down. So depending on where you were able to sell options, when volatility collapsed, you can not only make profits from the price movement, but also from volatility changing. And in this case, if we're expecting volatility to rise from here by buying options, we would not only make a profit from from the directional move, depending on whether we're bullish or bearish or neutral. Again, let's say we were bearish. Okay. Well, when we're bearish, got quite a few different strategies we can do. We could buy a put. We could buy a bear put spread. Right. We could put on a ratio spread. Let's see, what else can we do? We could sell a bear call spread. You could sell a call, but that's unlimited risk. I don't really want to do that if at all possible. If we expect it to only go a certain level, we could possibly do butterflies or condors as well, or iron condors. But there's a lot of different choices that we could do if we're bearish. However, now when we look and see the options are relatively cheap, I'll probably cross off the sell sides, and the ratio spread is typically going to be a credit spread too, although I could do a ratio debit spread too. But I'd more lean on the buying because the options are relatively cheap, but they look like they're going to be getting more expensive. Again, if I go back to, here's my trade station. Let's bring up this chart. QQQ. And studies, add. Here we go. Implied volatility, all options. Oops, I need to go to daily time frame though. Doesn't work on a 5-minute. And this is what I was talking about, just looking at implied volatility itself. We can see implied volatility versus its average. Well, price and almost everything when it comes to these markets is mean reverting. Okay, what happens is we move away from an average and snap back. We move away from an average and snap back. But you got to keep in mind the average is moving as well. So sometimes if we move an extreme amount away from the average, we will in fact drop back down to that average. Or if we drop below the average, we will rally back up. However, sometimes, if I go back like this a little bit, here we are at an extreme away from the average, but instead of rallying up strong to the average, what happened? The average came down to meet us. And there we are touching the average again. But we would have been in a losing position if we were betting on volatility going up. Here. Because at the entry point, volatility was right around 25. And by the time it met up with the average, it actually dropped a little bit rather than going up. So that's one of the dangers, obviously, is that, if we were in section 2 and expecting volatility to go higher, it could have gone lower or even gone sideways and had the average come up to meet it. So that's a risk that we run into. Let's see, when was that? Remove this. This was 5.2 to 5.23. 5.2. Where is it? Nope. 5.2. 5.23. And we were in section 3. We actually dropped into just below section 3 in section 2. And what happened? Well, the average sloped down, unfortunately, instead of us rallying up to the average. Yeah, so I want to be able to kind of take a look at both those. There's probably an indicator on TOS as well that I just don't know. I also have this indicator for TradeStation, but I don't think I have it on this computer. I think I forgot to upload it. Let's make sure. Add study. Nah, I forgot to bring it on this one. I'll have to upload it. Anyway, I share it with my students, like I said, in my classes. So if you join one of my courses, the SPX or the E-mini Think Tank, you get a copy of that indicator if you want. But you can always build it yourself. Like I said, if you can get a hold of the historic volatility, or even again, just looking at, well, currently, I said we were in section 2, I believe. So options are relatively cheap, but they could become cheaper. We are looking at a little bit of an increase recently in implied volatility. We are trading barely below the average. That average has dropped dramatically right now. So I don't really have a bias in either direction. I could do credit or I could do debit in this case. Typically, what I'm looking for is prices to be leaning hard in one direction or even leaning a little bit in one direction or the other as far as options being cheap or expensive. Again, if I go to your Option Station Pro, yes, the average is a red line in this case. And I'm not sure exactly how long they had for the average, 20 days. So roughly one trading month. That's what we're looking at. And where's my OS Pro? There we are. So I bring up those same options. I think it was July 25th we were looking at. Let me make sure. Yes. And, oops, sorry, wrong security. That's better. Too many strikes. There we go. And I was saying, if we put it together a spread, again, you see, click to analyze. 527. Oops, what did I do here? Oh, actually, no, I wanted that. Excuse me. Let me go back over to my analysis, remove. Okay. So again, at 527, the Vega 0.65, right? And if I do a buy, there it is. I can see I've got my delta at the money option, but the main thing is I was worried about the volatility risk, and I have a Vega of 0.65. I also could go in and sell the 530. And by selling the 530, I changed my delta. Okay. Okay. Yeah. Sorry. So now when I go to analyze this, let's see. It's going to show me, it'll show me right here. If I go plot 1, no, plot 2. And that's the wrong date. So let me fix that. Which I will keep 2 dates there. In addition to expiration. There we go. So basically, I'm looking at current pricing. And let me pin this at last price. There we go. And at last price, my theoretical P&L is pretty much 0 because obviously I'm buying it for what it's valued at currently. And you can see my Vega has dropped to 0.36. And the reason why I've reduced my volatility risk is plain and simple. I created a spread where I have positive Vega and negative Vega. And they're offsetting each other almost exactly to 0. Basically, when you're looking at this analysis, this should be times 100 for everything because my delta, yeah, 0.54 and negative 0.51 gives me a 0.03. But when you go to the analysis, it's showing 3.79. So basically, I've reduced my volatility risk to almost 0 because I have positive and negative Vega. It becomes not as critical in 30 days left, but when I go further out in time, yeah, let me get rid of these. I don't know why it wasn't showing on the other platform as well, but maybe I was doing something wrong. If we go out to 90 days, like I said, add the extra time. And now I have to choose different legs, unfortunately, because I don't have those other strikes available. But if I did 525 and 530, for instance, I had a Vega of 103 and 105. If we just bought a call, well, actually, we're supposed to be bearish on this. Doesn't matter. It's fine. Bullish or bearish. You can see that I had 103 or 103 delta risk. Let me show you. Go to analyze. There we are. And there's my Vega 103. Get rid of the other 2 for now. So I have a lot of volatility risk by just buying the call if I'm bullish. But if I sell a call at a price level where I know prices aren't likely to get to before I'm willing to exit the trade, or I'm going to be, I expected to hit supply and turn by that point. I just sell an option above that level. And let's do 540. We'll give it a little more room this time. So add that in, go back to analyze, get rid of the first one. And there we've got our delta now. I'm sorry, Vega from 100 down to almost 0, 1.85. But the drawback is I reduced my delta, which is my profit as prices move. Remember, you can't have lower risk without lower reward. So I've capped my reward, I've capped my risk, and neutralized the Vega at the cost of giving up a bit of profit. So as prices move up, I will not be participating as much with the move up as I would have if I'd only done one of the options rather than 2. Actually, I should have them both here side by side. Let's do that. Trade. Analyze. There we go. So you can see the single call option 57 delta versus the spread 11. So for every 1 point the Qs move up, I only gained $11 on the spread, but I gained $57 on the single call, buying the call. But I'm also reducing my Vega, like I said, from 103, I think it was. If I take out, there we go, 103 down to almost nothing. So it just depends on how much risk you're willing to take. And obviously, I can adjust that by the type of option that I sell. The further out strike that I sell, if I go from 540 to say 550, I'm taking on a little bit more risk now. So that negative 101.0 something, now I'm at 2.25. My delta's gone from 11 to 19. It's going to cost me more as well. Spread will cost me a little bit more than what I had before, but my reward goes up. I didn't change the price in there. I just changed this, didn't I? I'd have to change the price into current prices to show you that. But there's ways of neutralizing the risk. And again, one of the big things that I'm looking for is I want to make sure that when I buy options, I'm buying cheap. When I'm selling options, I'm selling expensive. And I can also look here. Let's see, do I have it open? No. And change these columns as well. Theoretical value. Get rid of these two. There we go. And right now, these 90-day options, let's see, theoretical value, 38. I could definitely buy cheap because right now, even the ask price is 26. Theoretical value is at 38. What are they on the 35 days left? Yeah, I was using the 527s. If this is right, these are undervalued. 22.95 is the value, theoretical value right now. And I could buy this for about 14 bucks. That's a pretty good discount. Let me check on the other program to see. Trade. Theoretical value. Single. 527. So this is showing a different theoretical value. They're using different models, I'm sure. I didn't think it was that underpriced. I think there's some problems with the pricing on the trade station. This one's a little more accurate, I think, as of right now. And I would expect it to be relatively even priced because we're trading pretty much right at the average when it comes to implied volatility. So if I can find a security that's trading well above implied volatility, we might have very overvalued options that would lean towards a shorting opportunity. Let's see, let me open up a new radar screen for that. And you can probably do scans on the Thinkorswim right as well, but I can do this one relatively quick because when I go into this, actually, I'm going to do data hot list. And while I'm at it, settings, page, I think that's it. There we go. And get rid of that for now. Window. There. All right, we're good. So basically what I can do here now is find under the radar screen, we got volatility lists. So I can look for highest implied volatility or implied volatility changes, implied volatility breakout above the average, a couple different things. Statistical volatility versus implied volatility, all sorts of searches. And let's see here, time frame. What's going on? Daily. There we go. So now I can look for securities that have extremely high implied volatility if I'm interested in selling options, or I could do the same thing, break downs and see if there's low implied volatility for cheap options, depending on where I expect the overall market, perhaps the sector, and even the individual securities to go. So let's see, VOYG. Is that a new stock? Must be. Not getting any history on it. So we'll move on. I don't want to deal with new stocks. BSV. Ugh. That doesn't look good. See a CSW. That's really weird. This implied volatility that I'm getting. They say it's breaking out. I don't know if this is the right list. Like I said, I can do some filters as well to make sure that they're decently priced securities, that the options have good volume as well, open interest, excuse me. That's actually something I can put in here as well. If I go into my studies, let's see, add, because I want to make sure it's tradable. Open interest. There. Now, open interest greater than 10,000. And unfortunately, there's nothing there. Let me just make sure that's the right study. All options. Let's try that one. Greater than 10,000. There we go. Now we have some securities that actually have volume on the options that we could possibly trade. This one's probably not going to work. That might be, I think that's a takeover, Springwork Therapeutics. Something happened there where it's just got flat. And these are too cheap. So we'll look at, let's see, breakout below. There we go. And again, I want open interest greater than 10,000. Narrow that list down. So these are extremely low implied volatility compared to average, and they have decent liquidity on the options, potentially. There we go. Low implied volatility. And you can see this one does snap back quite a bit. So this may be a decent candidate for simply playing volatility as well. We don't even necessarily have to play direction, but we can also look at that as well. I can also take a look again, IEI. That's an ETF. IEI. And we see that, well, even though implied volatility might be relatively low, it is in section 3. So options may be just decently priced. It may not be having an opportunity here with the volatility. Yeah, I'm getting kind of conflicting data on the implied volatility from different brokerages. All right, toss and okay, Nokia. Let's see. Oops, what happened there? Yeah, not really that high. It may just be this account too. This is a simulated demo account that I'm using. Last price. These are all really cheap. FSK. Volatility looks like it's broken down. FSK. Well, I'm specifically looking for things that have very low volatility. This is in section 2, not too low. It's below where it's been in the past. So there may be a rise in volatility coming. Again, I could look for an opportunity depending on where I think this is going to go. Although it looks pretty neutral. It looks like it might just go sideways. I could actually check for a strategy that would profit from an increase in volatility only and be directionless, which in that case, it would actually be an iron condor or a butterfly I could put on. Again, just looking at the overall direction of security. In this case, I actually started by searching volatility first. Matter of fact, in simulated mode, you can create scans. And in the filters, should be able to go into volatility for these. Yep, implied volatility. And you can actually set up scans here as well, just like I did with the radar screen on TradeStation. So again, I could go ahead and continue searching different things. We see implied volatility lowest. And I need liquidity again. So we look at open interest greater than 10,000. The SPY is going to be pretty much similar to what we saw in the Qs. So it should be relatively moderate implied volatility right now, rising off the lows. And well, these don't look bad. PSQ, low volatility, not moving much at all. And verified over here as well. Chart. And we might have missed it already. It jumped a little bit in volatility. You can see that we went from volatility around 12% to 26 and more than doubled. So that's what I'd like to find is something that's very low in volatility, expecting it to go up. You would profit not just from the price move, which it really didn't move much, but also from the volatility. So overall, There you go. You too, Jeff. Basically, when I'm looking for trading opportunities in the options markets, I start off obviously looking at the underlying security. I can also start off, like I showed you, looking at volatility to see if there's high or low volatility on securities, and then do the analysis on the underlying. But typically, I'm looking at the underlying security and seeing it. Do I think it's going to go up, down, or sideways? Then once I do that, I look at really implied volatility. You can compare either implied volatility to historic or to itself and see how it is compared to the averages. If implied volatility is relatively low and I'm expecting it to rise, I want to lean on debit strategies because I'll profit from the rise in volatility. If volatility is very high, I'm expecting it to drop. I may look at selling options because, again, that collapse in volatility will assist me in collecting extra premium, even if the prices don't move as much as I expect them to. And then I choose and manage the strategy accordingly. I'm not sure where it is. I'm sure there's a tool here in TOS. I'm just not sure where it is, but I do know in TradeStation, one of the other cool things is I can go in on my Option Station Pro and go to search. So for instance, I can look at SPY real quick. While that's loading, I can look at the chart of SPY. And again, we're seeing that implied volatility is pretty much right at the average. It is rising off the lows, may continue to rise, but we're not sure. And again, even putting it in here, you can see it's rising in level 2. So we still want to lean a little bit on buying options. Well, if I'm expecting it to, let's say we're bearish on the security, I can go to bearish. I can choose limited or unlimited risk. Or if I'm playing volatility, we have quiet or active markets. Let's say I want limited risk and I'm expecting prices to drop. And I can put in how far I'm expecting it to drop. Let's say we're expecting it to drop by 3%. Okay, so, negative 3%, not bullish. There we go. Expecting it to go down. How long do we expect to stay in this trade? Maybe a month. Let's see. And what kind of volatility move are we expecting? This is where it's nice to see where we are compared to the average, because if we snap back to that average, I can choose that. Perhaps I'm expecting volatility to increase by about 7.5%. There we go. I can actually run a search. Let's do 50 and take a look at different strategies. For some reason, it's only giving me single legs, but I can look to see if there's certain strategies that might be ready for this. And notice it's going on the buy side for the most part because I'm expecting volatility to rise. If I was expecting it to drop, they might be giving me the sell side. Let's see. Negative. And not so much yet, but again, it's not all the scans there. Anyway, I got to run. Hopefully you gave you a little bit of an insight. As like I said, for the steps that I do, those 3 main steps is what I'm typically looking at for my trading for the options. Figuring out the underlying security direction, options cheap or expensive, and then figuring out what strategy works best for what I'm trying to do. So thank you everybody for being here. I appreciate it. And hopefully I'll see you again soon in one of the classes. So trade safe, trade well. Take care, everyone.